Hello, financial enthusiasts! Welcome back to our channel where we reveal the secrets to financial success in building a solid foundation for a brighter future. In today's video, we'll be providing you with an introduction to futures trading. It's an area of interest that many people are exploring, so we thought it would be beneficial to break it down from the fundamentals. If you're interested in more videos about futures trading in the future, please let us know by commenting below and liking this video. Additionally, we would greatly appreciate if you could subscribe to our channel and click the notification bell icon. Now, without further ado, let's dive right into it. Let's delve into the concept of futures. What is futures? Futures refer to financial contracts that are derived from an underlying asset, and they require the involved parties to buy or sell the assets at a predetermined price on a specific future date. It's important to note that both the buyer and the seller have an obligation to fulfill the contract. The buyer must make the purchase, and the seller must make the sale, regardless of the prevailing market price at the expiration date. It's worth mentioning that many individuals who are currently exploring futures trading are those who have previous experience trading options. In contrast to options, where you have the choice to execute the contract when it expires if it's profitable, in futures trading, you are obligated to fulfill the contract. The key word here is obligated. However, it's important to note that in most cases, when trading futures, we are not actually trading the physical contracts themselves. A considerable number of individuals choose not to trade contracts, and there are also many others who avoid doing so. However, it is important to bear in mind that futures contracts carry significant binding obligations. Underlying assets in futures contracts can include physical commodities and financial instruments. These contracts provide specific details regarding the quantity of the underlying assets and are standardized to facilitate trading on a futures exchange. Futures can serve two main purposes: hedging and trade speculation. A notable example of hedging is seen in big oil companies, where they hedge their current oil inventories to mitigate potential risks in the oil market. Similarly, hedging can also be applied to other markets like corn. Now, let's move on to the second part, when the term futures is used by traders and investors to refer to the overall asset class. Within this asset class, there are various types of futures contracts available for trading. Commodity futures involve underlying commodities such as crude oil, natural gas, corn, wheat, and even precious metals like gold and silver. Another type is stock index futures, which attracts significant attention. Examples include S&P futures, NASDAQ futures, Dow Jones futures, and Russell 2000 futures. Additionally, currency futures are also traded, including Euro futures and British pound futures. The futures market offers a wide range of trading options encompassing numerous assets. This market allows for trading not only in commodities like corn, crude oil, and precious metals, but also in bonds, interest rates, and more. The list of available futures contracts is extensive, offering ample opportunities for traders. On the other hand, the options market has more limited options in terms of what can be traded. While it is possible to trade options on individual stocks like Apple and AMD, as well as ETFs related to commodities like corn, it is often more favorable to trade the corresponding futures contracts directly. Among the various asset classes available in the futures market, we will focus on explaining the most popular ones: S&P futures, micro S&P futures, NASDAQ futures, and micro NASDAQ futures. These futures contracts attract significant attention from traders. In the case of S&P futures, each point movement in the futures contract corresponds to a value of 50. For instance, if the S&P futures are trading at 3,900 and you buy one futures contract, if the price increases to 3,901, you would make $50. If it further increases to 3,902, your profit would be $100. This point system simplifies the understanding of risk and reward. If you're targeting a 10-point gain, you would stand to make $500. On the other hand, if you're willing to risk only 5 points, your potential loss would be around $250. The point-based valuation system in futures trading provides a straightforward way to assess the potential risks and rewards associated with price movements. Now, let's discuss the micro S&P futures futures, where each point movement corresponds to a value of $5. This particular contract is more suitable for smaller trading accounts or individuals who are new to futures trading. Trading micros is a prudent choice when starting out to avoid depleting your account due to initial lack of experience. In this case, if the price of the micro S&P futures increases by 1 point, say from 3,900 to 3,901, you would make $5. If it goes up by 2 points, your profit would be $10 and so on. Conversely, if the price drops by 10 points, you would incur a loss of $50. In summary, in the micro S&P futures, each point movement represents a value of $5, while in the standard S&P futures, each point corresponds to $50. Now, let's shift our focus to the NASDAQ futures, where each point movement is valued at $20. For instance, if the NASDAQ futures are trading at 12,000 and you decide to take a short position by selling one NASDAQ future, a 10-point decrease in the price would result in a profit of $200. Conversely, if the price goes up by 10 points, you would incur a loss of $200. Similarly, in the micro NASDAQ futures, each point movement corresponds to a value of $2. This allows for smaller position sizes and lower risk exposure. There are significant differences between options and futures. Options come with additional factors known as Greeks, such as delta, gamma, theta, and vega, which affect the pricing and movement of the contract. These factors contribute to determining the cost of the contract and how it moves in your favor. However, in the options market, even if you purchase a call option in a stock and the stock price increases, you can still lose money due to various factors. On the other hand, in the futures market, we profit or lose based on every point that the future moves in our favor or against us. Futures tend to have lower volatility compared to options, and the price action in futures is often considered cleaner and more straightforward. When comparing the price action in Forex to futures, they are quite similar. However, in the options market or the general stock market, you often need to conduct more analysis to understand the direction of the underlying asset. In contrast, futures trading is relatively straightforward in my opinion. If you're interested in starting to trade futures, there are numerous brokers available. Depending on your capital, you can choose from brokers like Think or Swim, Interactive Brokers, Tastyworks, and many others. Keep in mind that funded accounts may have certain requirements that you need to fulfill. If you enjoyed this video, please consider hitting the like button. If you appreciate what we're doing here, make sure to subscribe to Stock Market Catalyst and click the bell icon for notifications about future videos. If you have any feedback or topics you would like us to cover in future videos, feel free to leave a comment below. Thank you so much for watching and stay tuned for the next video.